Now ask yourself, who's taking possession of 62,875,000 ounces? We can look at the January 5th delivery report.
Over 62 million ounces of silver didn't disappear into thin air. It was taken off the market by some of the most sophisticated financial institutions on Earth. While headlines focus on price swings, Andy Schectman explains why the real story is happening behind the scenes in physical delivery.
Now ask yourself, who's taking possession of 62,875,000 ounces? We can look at the January 5th delivery report where Deutsche Bank, now there's a rumor out there that the European banks are in hot water.
Mm-hmm.
And I talked with you about this.
Sorry to interject, but you've told us in previous appearances that you believe the U.S. banks, especially the JP Morgans, have flipped from being net short to net long, and the ones that are still sort of stuck long were the European banks. So this
well, that's what the Economic Times said. Now, that was an article, and it's interesting. One of your subscribers, one of your followers sent me an email, said, I can't find it. So he and I go back and forth, and if you put it into Chat GPT or one of the search engines, it says, yes, indeed, this article is real. This article was published. You go to the Economic Times site, it was pulled. It says this is no longer here.
Oh, wow,
interestingly enough. But one of your subscribers and I had a nice conversation back and forth about this, and we validated that it was there, that what I read and what other people talked about was real, and then they pulled it. Anyways, Deutsche Bank on January 5th issued, in other words, they delivered 3.27 million ounces. And who are the buyers? JP Morgan and Citigroup. They are the largest derivatives holders on the market. Now, when I say JP Morgan has flipped, according to the Economic Times, that doesn't mean that they don't have short contracts. They do. It just means that they're net long and exposure to more long than short, which is a big rarity. But the bottom line with all of this is that the deliveries coming by the most sophisticated, well-funded traders in the world who are not using leverage, that is more important than anything. Yes, you can talk about the fact that it has been classified a critical mineral. Huge. You can talk about the fact that the European Union did it at the end of 23. Huge. You can talk about the Chinese export restrictions. Huge. But when the most well-informed traders in the United States are standing for millions and millions and millions and millions and millions of ounces of silver every single month for going on 15 months now, that tells me that we are nowhere near the top. But you have end of quarter, end of month, end of year, selling, balancing books, taking profits. There's something on COMEX that is called Section 1256. Most people haven't heard of it. It basically says if you trade gold or silver futures on a registered exchange like COMEX, that you, no matter how long you hold the trade, it could be a day, it could be a week, it could be minutes or hours. When you sell it, the IRS automatically treats 60% of the gain as long-term, 40% as short-term. And that's a very big deal for active traders, of course. And of course, at the end of the year, the IRS also assumes that all open futures positions are marked to market. So there's a lot of, they can sell it, book it, buy it right back, and it doesn't trigger the wash rule. 30-day wash rule is something in securities that says if you sell a security for a gain, you can't buy it or anything else like it, or a loss, excuse me, more appropriately a loss. A very wealthy person sells a rental property for a big loss to offset a gain on Apple stock or something. You can't buy that or something similar back to it for 31 days. So in any case, all I'm simply saying is that there are a lot of things happening at the end of the year, whether it be shaking the bushes, huge deliveries, rules on COMEX that kind of make traders clean the books and then come back in. And then, of course, we have some other things that we'll get into about silver that I think are going to make this month incredibly volatile. The rebalancing of portfolios where silver has gone up so high, it's now a disproportionate share of portfolios has to be rebalanced. At the same time, you got hedge funds, the January effect they call it, coming in with all this cash. What are we going to buy? How about the best performing asset of 2025? now that just got hammered down because of rebalancing, because of all of these things. No, the deliveries expose the rhetoric that these players who are standing for possession of billions every month are not doing this for the hell of it, Adam. It's just beginning. But to think it will be easy is fooling yourself. It will not be easy.
Okay. And by will not be easy, I'm presuming
Volatile.
you more mean volatility, which is
Yes.
there's going to be a lot of shaking of the bushes here, and
Yes,
you want to hold on as best you can through it.
right. The physical holding means nothing. I mean, there's no reason to sell your physical, not even close. But the paper price, which has a lot of speculators involved playing against some of the biggest institutions in the world with unlimited checkbooks, they won't make it easy for those guys and gals to hang on. They're going to get shook, I think, extremely hard over the next couple of weeks into the end of January.
Okay.
Andy starts by asking a critical question. Who is taking possession of tens of millions of ounces of silver? When you look at delivery reports, names like Deutsche Bank, JP Morgan, and Citi show up. Not retail traders, not momentum chasers. These are institutions with deep balance sheets, long time horizons, and access to more information than almost anyone else. One of the most important points Andy makes is about positioning. According to reports referenced from the Economic Times, U.S. banks, especially JP Morgan, have shifted from being net short to net long silver exposure. That doesn't mean shorts don't exist, but it does mean the balance has flipped. Historically, that's rare, and when it happens, it usually signals preparation, not speculation. Andy draws a clear line between paper price volatility and physical demand. Futures markets are dominated by leverage, algorithms, and short-term traders. Physical delivery is different. Standing for delivery means real capital, real storage, and no leverage. When that happens consistently, month after month, it suggests conviction, not a short-term trade. He also explains why volatility spikes at year-end and quarter-end. Section 1256, portfolio rebalancing, profit-taking, and mark-to-market accounting all force trades that have nothing to do with fundamentals. That can push prices down temporarily even while physical demand stays strong. The core message is simple. Volatility does not equal weakness. When the most informed, well-funded players continue taking physical silver through price swings, it suggests the story is still unfolding, not ending. The price may move violently, but the positioning tells a longer-term narrative. This video isn't about predictions, it's about understanding how institutional behavior differs from headline price action.